All right. So thanks everyone for being here and being here on time for the most part. I'm Jason, and some quick ground rules before we get started. We're going to run through the presentation first and reserve all questions for the end. So we reserved Q&A time at the end. So that doesn't preclude you from putting questions in the Zoom chat. And at any point, you're welcome to do so since we'll be monitoring it. Either Jake or I will respond. However, if it's more nuanced question, we may say that we can wait until the end to actually respond to it if it's more something we should reserve for everybody else to kind of hear the rationale behind it. All right. So today we're going to introduce you all to our team here at Wedgewood Capital Group and our backgrounds. I'll give an overview of the investment opportunity of 347 Broad. I'll then pass it over to my partner Jake here to dig into the property itself, as well as the business plan we intend on executing. He'll then pass the baton to me to walk through the geographic market and underwriting analysis, and then we'll finish up with some Q&A. So we're looking forward to really discussing with you the 347 Broad, which is our newest acquisition in Lehigh Valley, specifically in Emmaus, Pennsylvania, that we're formally raising capital through by way of the SEC or a syndication, which allows, for those that don't know, passive investors to own basically a part of the real estate without the liability exposure or responsibility. I would say it's more analogous to owning a stock in a company. So for those that are not familiar, my name is Jason Brignoli. I'm the co-founder and principal of Wedgewood Capital Group with my business partner, Jake Lord. And so I run the acquisitions in capital markets, and Jake heads up asset management. And a little bit of background on Wedgewood Capital Group. We started investing in real estate projects in 2019, whereas the first project we completed, we painted Wedgewood Blue, which is what we named the firm after, as a reminder to never forget where you started. So when I say projects, starting out, Jake and I were the ones holding hammers, doing the demos, scraping the paint, and have the bruises and scars, some physical and some emotional, to prove that. Jake and I have been scrappy and resourceful from the very beginning. I'm sure 9 out of 10 people have transacted on Craigslist. Now, how many of those can say they've bought a property on Craigslist? Maybe 1 out of 10, and that one being Jake and I. What Wedgewood Capital is today is a vertically integrated investment firm with a property management company where we own and manage hundreds of units in the Lehigh Valley, of not only of our own units, but also of other investors, being a staunch steward of their assets. Now, additionally, we partnered with one of the most prominent commercial real estate brokerages in the Lehigh Valley to be their property management partner for their clients. And also, we're on tech spaces with the mayor of Allentown, which is the largest of the cities in Lehigh Valley. In total, we've acquired over $5 million worth of investment properties, raised roughly $350,000 of capital, of which all principal and advertised returns have been delivered, that were closed closely to 20% annualized returns, and then managed through our subsidiary property management company, roughly $20 million worth of multifamily properties solely in the Lehigh Valley, where this asset is that we're speaking to today for 347 Broad. We've built the property management company because we knew how important proactive and hands-on management was to optimizing the margins. And if you really want to understand how to drive returns, it's important sometimes to know real estate from the inside out, starting with the management and really earning the returns on a daily basis. We have some of our clients gracefully on the call today and from our management company, and we're really grateful for them and hopefully feel that we practice what we preach by way of bringing a purpose-built multifamily management company to Lehigh Valley that is solely focused on creating as much value as possible for your properties, as well as our own. Our office is based in Allentown, Pennsylvania, and is actually located just a few miles from 347 Broad Street, which is the name of the opportunity, 347 Broad. And so we're intimately familiar with the immediate location, submarket, and the idiosyncrasies and nuances of the real estate trends here. We're really boots on the ground, and it's served us well thus far. And a little bit about me before I pass it over to Jake. to introduce himself and talk a bit more about our asset management capabilities as well as our in-house property management company. So I have a background in mechanical engineering from Penn State, where Jake and I were actually classmates, and have a background working in early stage startups, having learned some intimately from some great entrepreneurs. One of them is on this call today, so shout out Bruce from the West Coast. And lastly, I'm a third generation landlord for what it's worth. My dad, Robert Pergoli, he's not on the line today, but I thought he would be, is also a partner on this deal. And we're very fortunate to have him on the team. He's had a laudable career in real estate as a real estate attorney by background that has started his practice in the 80s, and additionally started buying multifamily properties at the age of 19 and developed and invested in many millions of dollars worth of multifamily properties. And lastly, was a part of the largest multifamily acquisition in Staten Island at the time, 10 years ago, for roughly $90 million. And now I'm going to pass it over to Jake to give some background on himself.
Yeah. Okay.
Hey guys, thanks so much for taking the time this evening to learn about this investment opportunity. We are really proud and excited for this deal, and we can't wait to have you guys joining with us in its success. As Jason said, my name is Jake. I am the founding partner of Wedgewood Capital Group, along with our affiliate property management company, Ethel Street Management, which currently manages over 160 apartment units in the Lehigh Valley and growing. As Jason touched on a little bit, we have worked together just about on every real estate transaction that each of us have done. We began buying in a college housing market in upstate New York, taking on distressed small multifamily assets, renovating them and renting them out to students and families. These first renovation projects taught us a ton about the intricacies of real estate and the nuts and bolts of how a building operates. We had the opportunity to get our hands dirty, taking on certain aspects of the project ourselves while hiring out and managing contractors for others. We then migrated to the Lehigh Valley, buying long-term hold small multifamily rental apartments. And through the blood, sweat, and tears that came from each of these investments, we've learned what to look out for and how to anticipate problems that can end up costing us a lot of money, and how to find creative solutions when necessary. We found that these experiences have really prepared us for a project of this size, and we're really looking forward to executing on the business plan. As Jason talked about in this partnership, I've overseen the execution of renovation projects and day-to-day management of our personal investments, along with our property management company, which I'll talk a little bit more about in a second. This role and responsibility that I've had will carry over into the 347 Broad Street project, as I will oversee the execution of this renovation business plan and the management of that asset to follow. Jace, you can, yeah, okay, cool. So I'd like to take a little bit of time to divulge a little bit more info about Ethel Street Property Management and why this aspect of our operation serves as a differentiator amongst other real estate private equity firms. We offer a vertically integrated service, handling every important aspect of the transaction from the moment the opportunity is identified, and then handling every important aspect of the management of the asset from the moment the property is purchased all the way when it is sold on the back end and the capital is returned to you guys, the investors. Having our own property management and asset management arm to the business provides greater insight and visibility into the performance of the property and of the investment, as well as greater control as to how exactly the asset is managed day to day. We will be utilizing tools and systems that we have already built and utilize to manage the 160 plus units in the Lehigh Valley that I had mentioned previously. And we'll be offering this service to you guys, the investors, to manage this asset essentially at cost, allowing for greater performance of returns and ultimately more money in your pockets once this project is all said and done. A second important aspect of the day-to-day management of the asset is called asset management, which goes hand in hand with property management, but it's slightly different. It focuses on the numbers and on the data. So these two services actually complement each other really nicely, because any type of dissatisfaction in performance on the property management side would lead to a quick response for us, tweaking systems and strategy in order to meet or exceed the projected returns, which we'll talk about. Jason and I, along with Josh Tan, our head of finance, and other members of our team who focus on the financial performance of our property management company and of our current portfolio, will be meeting regularly to analyze the asset's performance and track important metrics that are commonly tracked by larger real estate private equity firms, such as economic and physical occupancy rates, capital expenditures, maintenance costs, etc. This is something that we, in fact, already do for existing assets. So once again, this is plugging and playing existing systems. I'll give the mic back to Jason, and I'll talk with you guys in a few minutes about the property condition itself and some of the capital improvements that we'll be making to the building and to the apartments.
Thanks, Jake. So before jumping into the opportunity itself of 347 Broad, I do want to highlight a couple things. Josh Tan, the picture you see here, is our head of finance of Wedgewood Capital Group. He's actually built out our financial infrastructure for our real estate companies, including the property management company, as well as the portfolio and asset management. He's a CPA by background and has worked as an M&A integration lead for multi-billion-dollar public transactions, integrating financial statements, and turns out that was a natural fit when integrating statements of messy financials of LLCs and properties, and this was a walk in the park for him. Now, related to this opportunity, this has allowed us to create institutional grade financial reporting for investor reports and transparency into the performance of the asset, like Jake had alluded to. And I'll dig into this in a couple of slides, but there will be quarterly distributions to investors, monthly email communication for the first year, with reports on performance, and then quarterly thereafter. And we're generally highly communicative, and should there be something an investor would like to review ad hoc, we're happy to accommodate. We really believe that transparency breeds trust and communication gives comfort, and that's how we've been operating, not only for our clients, but also as a steward of their assets, but also previously when we've raised money. Being transparent is really important. Great, now let's really dig into it. This is where the fun starts. So jumping into 347 Broad, we have here a 13-unit property with 10 covered garages and 28 parking spots that were actually under contract for $2 million. It's really classic workforce housing, very similar product that you see on this block. There's a lot of comparable multifamily assets that we can comp to and we'll talk more about the comps later, but for this property, it's situated in the south side of the Lehigh Valley suburb of Emmaus, Pennsylvania. And Emmaus has some really great qualities, such as top-tier schools, easy access to the major transportation corridors, and sophisticated employment opportunities. To zoom out, it's really only an hour north of Philadelphia, and an hour and 20 minutes from New York City. And in my view, it's one of the Northeast best kept secrets in terms of quality of life, location, and affordability, but don't be telling everybody that until we close. Our key to actually winning this deal, acquiring it, was the fact that we have a great relationship with the brokerage group that is selling us the property, in addition to our local reputation that we've built over time. There were actually higher offers that came in over ours. However, we were awarded the deal. And also, just to highlight, we really like the story behind this deal. So the current owner has owned this property for about 10 years and recently planned on focusing his time to his other entrepreneurial endeavors in the jewelry business. And he's always managed the property himself and cares deeply about the property condition, being proactive about maintenance and empathetic with working with tenants who treated the units with care and respect. There was one tenant that we met that's been in the property for 41 years, and we'll get into her later. But so it's a really strong story. It's a great opportunity for us to come in and bring more attention to the asset. Additionally, the current ownership have really left the interiors 100% classic. So all of the units are untouched for the most part. And it's really rare to find an asset these days to have pretty much no upgrades of any kind cosmetically, with significant upside to raise rents, given the in-place rents haven't really been increased in several years in some instances. So we're going to be able to add a ton of value to these units through our renovation, which Jake will allude to. And we've underwritten this opportunity. And again, we'll dig into this later in the presentation, but at a high level, around an 11% net investor IRR, which translates to around a 13% annualized return over a 5-year hold period. And we feel that we're being pretty conservative across the board, strongly considering both macro and microeconomic factors when selecting assumptions that into our underwriting model. Our goal was to select highly achievable goalposts we can exceed, rather than overpromise and underdeliver and promise the world. Now, when it comes to the business plan, we're executing a traditional commercial loan with a way through a loan brokerage called GSM Commercial Capital. And they've placed the financing with People's First Bank of Allentown at a 5-year fixed 5.8% interest rate, which is a 75% loan to value, or in other words, a 63% loan to cost. And that we also got 1 year of interest only payments for financing. Jerome Powell, if you happen to be out there and listening, we beat you to the punch before we raised them again yesterday. And we secured pretty highly competitive rate in this market. Last time I checked, you can't even get above under 7 now. And so we got in pretty good. And so this fixed rate really locks in a predictable cost structure in these very uncertain times, while relatively lower leverage reduces the risk and offers more steadier returns. This deal is more of a permanent financing strategy with the 5-year term, and we're mitigating the maturity risk through modeling returns off of a significant cap rate expansion, meaning we're modeling our exit off of basically a 30% discount on the valuation in year 5 by way of a 190 basis point net cap rate increase from the going in cap. Additionally, some ways we're mitigating it. The maturity risk is obviously through the principal pay down, and then the hands-on management really to have that visibility into the day-to-day. With the initial value add business plan, we anticipate to take it about 12 months, and we will either sell or refinance 347 Broad depending on operational performance and capital markets conditions. A typical refinance would see a partial return on capital with a total period of holding of roughly 5 years at most. And we anticipate the renovation to cost roughly $160,000, and that we're putting aside roughly 4.5 months of operating reserves. So basically the property could not collect a single dollar in rent and operate 4.5 months out of the reserve. The investment opportunity offers an 8% IRR preferred return, meaning that all net profit cash flows first go to the investors up to an 8% IRR hurdle. Then the general partners start getting paid out, and essentially the profits are split thereafter to the general partners and to the investors. And this is a very attractive incentive structure for investors, since in every scenario, like the value of the venture for all parties, whether it's a sale, refinance, or operating cash flows, the limited partners are paid out first in priority order before the GPs. And so there will be quarterly distributions that, per our projections, should begin by month 9 and quarterly thereafter. The reason why it takes about 9 months to begin the distributions is because we'll be renovating the units and turning each of them over. And so once the property starts performing to projections, we will then begin the payouts as it turns a profit. And so the dividends could start sooner should the business plan take less than 12 months to execute, which we think is highly feasible. However, in the spirit of under-promising, we'll stick to 12 months as an achievable guidepost. And the projected IRR clocks in for the project around 13%, and then the net investor IRR around 11%. And so taking a look at a 100K investment example, on the screen here, you can see the projected dividends in total each year, in addition to the modeled 5-year exit payback. Should the market soften, rates come down a little eventually, and stability return to the overall world, let alone real estate market, we'll consider selling the asset sooner, which would also boost total returns potentially. If we can meet or exceed our projected returns prior to year 5, we'll seriously consider selling, and thus annually we'll engage a broker to provide an opinion of value of the asset and evaluate it accordingly. And lastly of note, the general partners are putting in roughly a little over 15% of the total equity in the deal, which we feel is an important thing to highlight, which is definitely a little bit more than typical syndication by way of just us wanting to put more skin in the game. And additionally, this is recourse, and so it's our butts in the line, and we're really are going to do everything it takes to make this successful. And with that, I'm going to pass it over to Jake to talk through the nitty-gritty of the property, its condition, and how we intend on executing a risk mitigated renovation business plan and our hands-on management approach.
Great, thanks. So talking a little bit about the unit mix, so essentially the breakdown of the number of bedrooms in the apartments and just overall how many buildings on the property, et cetera. This is just a quick table summary. So the main building itself, which holds all the apartments, has 4 single bed units and 9 2-bed units. 8 of those were actually old classrooms. So I'll talk a little bit more about the building in a second, but the building was retrofitted in 1982. There's also, as has been mentioned a couple times, there's also a garage. So there's a separate building in the back, holds 10 garages and an office space. And then we have an additional 28 parking spots, which can generate additional cash flow. So looking at this table here, you can see that there is definitely some opportunity to increase rent, and this is a huge aspect of the business plan. So the idea here is to turn over the leases and while trying to keep as many tenants as possible in the building, getting rents to at market rent and potentially higher. We project that we can actually get rents potentially a little bit higher than what you're seeing here. But being more conservative, this is the numbers that we are looking at. Yeah, Jace, can you jump to the next slide? Okay, cool. So talking a little bit about the building itself, one thing that I really want to say is a reason that we're really, really excited about this investment is the property itself is in really good shape. It is it's well built. It's a solid structure. The existing owner, who's held it for the past 10 years, has taken great care of the building. And we think this is one of the reasons that this asset is, and this investment is really secure, is because the building itself is in really good shape. Just about all of the money that's going to be going into the renovation will be going into the apartments themselves, which will more directly lead to increased rents. So not to get too much into the weeds here, just talking about a couple different aspects of it. So big things you look out for when purchasing a real estate asset are things like the roof, the foundation. The roof itself is in really good shape. All of the roof has been replaced within the past 10 years. The front of the building was replaced within the past 5 years. There's one section that is older than 10 years, which will be replaced prior to closing. So roof is in awesome shape. The structure itself is built with brick and concrete and stone. So this has proven over time to maintain its structure and also serves a second purpose of being more fire resistant. So this building is just, as I said, is in really good shape. The parking lot, the garage building in the back, we're super excited about that. And then talking real quick about the amenities, there is communal laundry in this building, and the current owner is actually leaving behind a few extra coin operated machines for us to put into the room so we can generate additional cash flow there. And then each apartment comes with, or each apartment on the first and second floor comes with huge storage spaces that are adjacent to the apartment itself. So this is definitely a attractive feature for current and for potential tenants. All right, so talking a little bit about what we're going to be doing to this building, how we're going to be renovating. What you can see here is a picture, obviously, of the kitchen as it exists now on the left. What we just generally want to do is give the apartments a fresh, modern look while maintaining some of the character of the building itself. As I said, this was an old schoolhouse that was built in 1910 and was retrofitted in 1982. There is definitely the character that comes along with that, and we think we can leave behind some of that character while still giving it a fresh look. So just talking about some of the upgrades that we're going to be making to the kitchen, and something that matches what you see in the market for more modern apartments. We're going to be putting in vinyl flooring, not only in the kitchen, but throughout all of the common spaces and bathrooms. We are going to be probably keeping the existing cabinets because they do leave behind some of that character. We're actually going to be painting these cabinets and giving them a brighter, fresher look. And then installing stone countertops, stainless steel appliances, and new lighting. I will say that each of the apartments actually has a little bit different of a layout, and some of them have actually been slightly upgraded. So some have newer cabinets, some have counter backsplashes like subway tile. So we're going to be keeping those and taking advantage of some of the character that comes along with those features also. Just a quick look at the bathrooms. Generally, the bathrooms and overall the apartments themselves are in really good shape. So the bones and structure and things like the walls and baseboard trim and things of that like are in really good shape and can definitely be utilized. So this is just really a cosmetic facelift. We're going to be putting in new flooring in every bathroom. We're going to be actually keeping the existing vanities in most of these bathrooms, replacing some of the tubs and shower surrounds, replacing some of the toilets, doing a fresh paint job, putting in new shower and vanity hardware, new vanity mirror, lighting, etc. Again, going for a brighter, fresher, newer look. Looking at some of the common areas, as I mentioned, vinyl plank flooring is going to be going in all the common areas in each of the apartments. So that's kitchen, bathrooms, and living room. We'll be putting carpet in the bedrooms. But what we want is for when a potential tenant walks into an apartment, we want them to feel like this apartment is bright and new. And there's a few things that can be done while on a budget and in an economical way to make it feel newer and brighter and to provide a more modern look. And things like the vinyl flooring, as I have mentioned, fresh paint job throughout, and installing lighting or replacing existing lighting, depending on the features in each of the apartments as they are now, will allow for this newer look. In addition, we're going to be installing digital locks in each of the apartments' front doors. What this does is bring a more modern lifestyle and also helps on the maintenance side. So when facing turnovers, so one tenant moving out and another moving in, not having to replace locks, just changing the codes makes things easier and more economical for us. Talking a little bit about utilities, one low-hanging fruit I say to take advantage of when buying an older asset or buying an asset from an owner that may not have been as diligent as they possibly could when managing utilities is making sure that each of the tenants is paying for their own utilities. So what's great is that the infrastructure is really there. So on the electrical side, I should say, so all but 2 of the apartment units pay for their own electric. The building is electric baseboard, which I actually forgot to mention on that on one of the first couple slides there, but this is super important because we now don't have fossil fuels come into the building, and we don't have to deal with additional maintenance that may come along with having a fossil fuel heating system, things like furnaces and boilers. So it's electric baseboard, and each of the tenants pays for their own heat along with the rest of the electric in the apartments. We're going to be installing panels in the 2 final apartments to take the existing electric that is for apartments 12 and 13 that the owner is currently paying for, and moving those to the tenant's own panel so they can pay for electric, and we can pass off just about the entire electric cost. In addition, on the water side, this is another big way to increase the returns by decreasing the expenses. So right now there's 1 water meter. We are exploring the option of splitting out and having each unit have their own water meter. We're going to be analyzing these costs based on budget and based on the overall scope of work of the project. Then in this situation, the tenant is signing up for their own water bill, they're paying their own water, and we are not responsible for paying water for the tenants, of course. Now, if this option turns out to not be in the budget, we do have a second option called RUBS, or ratio utility billing, in which we're going to be billing tenants based on the size of their apartments and the number of bedrooms in their apartments. So still passing off utility costs, which is going to increase the net operating income that was presented to us by the current owner, along with the increasing rents, as I had mentioned before.
All right, thanks, Jake. Now jumping into more the nitty gritty on the market geographically, as well as the numbers. We're going to unpack that now. So we believe that workforce housing overall is a strong risk-adjusted value compared with newer builds. And what I mean by that is Class A, like the fancy apartment buildings. Sometimes, especially in recessionary environments, and additionally, more broadly, they deal with more new supply competition and are vulnerable to economic downturns and substitution by affluent lifestyle renters. In contrast, workforce housing has seen stronger rent growth and is stickier in downturns due to renter by necessity tenants and lack of new affordable supply. Lehigh Valley and the surrounding area is a business and landlord-friendly environment that supports strong economic growth, especially the proliferation of the e-commerce boom, labeling this area as the e-commerce distribution hub of the Northeast. There are phenomenal employment opportunities highlighted by some top-tier universities, corporations, and healthcare organizations. Also, not to mention our offices in downtown Allentown, and I'm pretty sure we're still hiring for an onboarding specialist and for team members as a part of our maintenance staff. But that's besides the point. So a little bit on the geography here, on a more micro level. At the bottom of the picture, the bottom right, is the location of the property where the yellow arrow is pointing, and a few miles north is our office. In addition, what I've highlighted are a couple major developments in downtown Allentown that have attracted the likes of the Kushners and the Manhattan Building Company, which were the 2 major developers behind the revitalization of Jersey City. Turns out they're in on the secret of Lehigh Valley, and we're excited to really welcome them. And we were actually here before them and capture the upside they bring in terms of their investments in infrastructure, attraction of sophisticated employers, and creating a modern and exciting culture of experiences in nightlife. I can send you all the links to what they plan on building and in the process of. I think you'll be pleasantly surprised. Now, in Emmaus, housing construction has reached the borough line in all directions. And so significant continued population growth in the borough is actually unlikely. And outside the borough line, the local population continues to grow, particularly in neighborhoods like Lower Mackenzie Township. So basically the growth in the Emmaus zip code specifically is growing slowly, except for beyond the borough limits, because Emmaus as a borough is only 2.9 square miles, and they don't want to build up anymore over there. And so it having been one of the top tier Northeastern Pennsylvania school districts, it's in very high demand, and people are just trying to get in there in a very small space. And Emmaus really has that Main Street like feel to it, decorated with tree lines, boutique coffee shops, and cuisine options to match that diversity. And this slide of the northeastern region really speaks for itself in terms of the proximity to the major metros such as Philadelphia and New York, and the attractiveness of employers with the need for space at an affordable price for such as manufacturing and warehousing. The Lehigh Valley has been dubbed the commerce hub of the Northeast for good reason. It really has, you can get to the entire Northeast corridor relatively quickly. Now into the numbers we go. So jumping into the investment analysis, it's important to keep things local when it comes to rental comps. And keeping that in mind, Emmaus again is only 2.9 square miles big, which may capture a lot of New York City, but not so much for a suburb in terms of population density or in total volume of Starbucks per street corner. Now, there are a few key apartment buildings numbered here in Emmaus that we've actually been inside all three of them as shadow shoppers while doing diligence research to figure out what the appropriate market rent was. And it was pretty easy to not look suspicious because it looked like just like everybody else who's a young millennial they're trying to rent to. And so it was pretty not hard to hide behind my face. Now, as for the market rent comps post renovation, there wasn't much renovated product available in Emmaus, which has us further excited about the demand for higher quality living. We've set our projected rents after the renovations to roughly $13.50 for the 1 beds and $16.50 for the 2 beds, which is below the competitive renovated properties in the market, which gives us an achievable benchmark to exceed. And should rents decline, a benchmark we can fall back to considering we've marked our pro forma rents between 10 to 15 below the competitors on top of the other conservative assumptions we've made on vacancy and things like loss to lease. And one exciting update was that a neighboring 10 unit, and when I say neighboring, you can throw a baseball from this neighboring property and it'll land on 37 Broad's backyard. It was listed for sale literally yesterday, and we got the rent roll, and it's all the units were classic, not renovated, and the 1 beds were renting for anywhere between $1,200 and $1,350, and the 2 beds were going for between $1,400 and $1,450, and no parking spots. And these were not renovated units. Now, going back to our projected rents, not only will we have renovated units with parking included, and each unit has a bonus storage room, but also we set our safety net considering, but also we set our post-renovated rents at pretty much closer to the non-renovated comparables, which gives us a safety net considering worst case scenarios. And we feel pretty comfortable going into the current macro environment that we're not stretching at all for rents, and we're really set reasonably. So going into how we modeled this deal, some key takeaways without getting too far in the weeds. We've modeled our pro forma returns off of a 10% vacancy over the first 2 years of ownership and then 7% thereafter. Historically, we've actually operated our 160 plus units in the mid 4s in economic vacancy, and we've modeled roughly 2% rent growth from years 2 to 5 annually. However, we beefed up our vacancy numbers, and we've increased our annual loss to lease, which really should capture enough delta should we see no rent growth from years 2 to 5 and operate just at or below our goalposts for operating expense targets. So my point here is really, again, we're pretty excited about our ability to protect the downside. We've modeled recurring CapEx per unit to be roughly $1,000 per unit per year, which is roughly 300% more than what typical institutional investors would underwrite for this product, which is roughly around $250 per unit per year. And additionally, we forecasted an additional $250 per unit per year in replacement reserves in concert with a 100% increase in routine maintenance and turnover costs relative to underwriting best practices for a property of this condition and asset class. Most importantly, we've actually modeled all expenses off of 14 units instead of 13 because of the garages. And although they are negligible maintenance typically for garages. But across the board, we feel good about our preparation to manage the margin going into the deal. And our goal is to minimize our fixed cost and be able to hunker down on variable costs should we need to, achieving true vertical integration because of our in-house property management arm, along with our asset management capabilities, working in concert and lockstep to achieve business objectives outlined. We've considered $0 in rental income for our parking spaces beyond what we will give free for tenants for the 13 units. And considering that this is an amazing location right behind the town center of Emmaus, we feel pretty confident that we'll be able to rent the additional 15 parking spaces for a decent amount of extra rent that was not included within our pro forma. So that's another upside opportunity. In addition, we have an office space that we had no idea there was an office space on the 3rd floor that we can actually rent out. It's I think almost as big as my current apartment, and so it's plenty big enough to rent out to somebody for a decent amount per month. And so that was pretty much like a newfound revenue opportunity that was not considered in this pro forma that you're seeing here, or even in the projected returns that I've committed to this opportunity. And so the parking rent and that extra office are just things that weren't considered, and still not, because I'm keeping them off the model. We also underwrote that we can only pass off 40% of the utilities through a RUB system that Jake alluded to. However, we believe that we can pass off close to 80% of that. And so there's delta there that we were being conservative on. And the seller gave us the extra washers and dryers that he never installed. And so we can drive more revenue for other income by increasing the machine count in the laundry room, which is in the basement. The covered garages for market rents are highly achievable, and we believe we can actually exceed this considering the desirable location and market comp data. And just to drive a point home, we've modeled our returns off of a significant cap rate expansion, more specifically the equivalent of a 30+% discount on the valuation by year 5, basically baking in a downturn. And should the market recover somewhat by 2027 or sooner, then that is all upside from the projected returns. I know that was a lot of math, and I appreciate all your patience. And there's just a couple more slides left, and then we're going to turn it over for Q&A. All right, so when it comes to investor experience, all documents, wiring, and distributions are tracked and administered through an institutional investment grade portal that we offer to investors. This makes the process seamless, where all documents, K1s, and related tax and investor documents will be housed in your document center, which you can see on the right-hand side next to the investments tab. And additionally, all documents can be signed through this platform, and this platform is trusted by investors for hundreds of thousands of rental units doing exactly this, but at a much larger scale. And we're excited to share this great experience with those of you interested in committing to this opportunity. It really makes it seamless. And then just the last slide before we wrap up here. So this is the investment ask and timeline. Starting with the timeline, the contract was signed on October 25th, and the SEC and syndication related investor documents will be prepared for review the 3rd week of November. The fundraising deadline will pretty much coincide with the capital call. And what I mean by that is, if you were to call me on December 14th and say you found an extra $50,000 under your pillow, you still can wire it that day. As for the, we anticipate on closing the end of the 1st week in January. And lastly, to date, we've had a pretty productive and competitive fundraising cycle, having over 2/3 of the capital needed and ready committed thus far. And it's a great signal for this deal, considering the market dynamics and people believing in our team to execute and deliver. Now, the minimum investment is $25,000, and we're taking commitments on a first come, first served basis with roughly $250,000 left in the round. And before opening it up to Q&A, I'd like to thank everyone your time and those that will be listening on the future recording link for this evening. And this really serves as a conclusion for the 347 deal opportunity. We're happy to bring to you from Wedgewood Capital Group, which is a vertically integrated investment firm based a couple miles from the 347 Broad opportunity in Lehigh Valley, and that we penciled an annualized return around 13% with quarterly dividends. And with that, I'll open up the floor to any questions. And thanks again for joining today. And so I'll stop talking so I can get a sip of water and someone else can chime in for a second.
Jason, Jay, great presentation, is Martin. I had a bunch of questions, but you actually answered a few. The ratio utility bill, the RUB methodology, I know also the coin machines, which that's exciting to hear as well. And the landlord and the prior owner, well, because you guys are gonna be the new owners. Well, we're gonna be the new owners. Got some machines in regards to, and the reason I'm mentioning RUB in correlation to sometimes tenants do have their own washer at home. Are we allowing them to have their own washer at home or not? So obviously, because I don't want to complicate things with the RUB model, right? Because when you use more water at home, you wash clothes at home, it consumes more water, or we're not going to allow that, and they're going to have to use the coin base downstairs.
Yeah, so great question, Martin. There's actually there's no plumbing in the individual apartments for washer and dryer. So the tenant would somehow have to sneak a washer and hook it up to the kitchen sink, which we don't expect to happen. So we should be in good shape there. And then I think just having that convenience of the coin operated laundry in the basement should really deter any type of issues. But yeah, that shouldn't be a concern.
Awesome. And in regards to the office space, I didn't hear that. That's news to me, by the way. It's exciting. Is the office space a brick and mortar storefront, or is it actually inside the building somewhere?
Yeah, the office space sits on the second floor. It was actually it was a utility closet. It's currently used as a utility closet for the existing owner. Being that we have a property management company, we have an office, our maintenance team has a warehouse, we don't really need a utility closet. So I think there's multiple things that can be done here, but it is a large space and definitely could serve as an office. It's just not like storefront type of office, right? So.
Hey, Dave, I see you have your hand up.
Yeah, thanks, Jason. Thanks, Jay. Appreciate all the information. Couple questions. I know it looked like you really did your homework on understanding what the market rents were and so forth. And then also there was a pro forma category. So just wanted to clarify, when you say market rent, is that what you're hoping to target right now, or is their current rent the market rent?
Dave, that's a great question. And so there's really 3 rents when you evaluate an opportunity. There's what is it renting at right now? There's market rent. Should you do nothing to the property and you're just a more aggressive landlord and you want to drive the returns further without touching the property, you can raise the rents to market rent. And then from market, should you want to do any improvements, those improvements can yield the pro forma rents. And that's where we're projecting based on our renovation plan.
Okay, thank you for clarifying that. And then the last question was on the back end in looking at the kind of the exit strategy, right? Whether it be a refinance and hold or sale, are there certain assumptions around that as it relates to like a cap rate and the anticipated market value, and how does that play into the multiple?
Okay.
Yeah, absolutely. That's a great question, Dave. And so we've basically modeled and so what I mean by a cap rate expansion is that the same net operating income today will be worth less in however many years. And so, for example, in simple numbers, is that a feeling someone would ask? If we bought this property at a 6.25 cap, which is the cap rate expansion of which I'm anticipating, that's like instead of buying it at 2 million today, we're buying it at 1.4. And so what I'm saying is, through a cap rate expansion, is that the new net operating income will be at a 30+% discount in 5 years because of that cap rate expansion. And so the market for multifamily cap rates is close to like 5. Well, it was, until, last couple months, but I'm saying it's going to be like 6.25. And so that basically is saying that there's going to be a lot of demand destruction in the near term. And should there be more equilibrium coming back into the market? That's pretty much all alpha that is now captured for investors.
Hey, Jason, just to kind of maybe elaborate on that, maybe talk about like how cap rate is a function of net operating income, and because we're increasing rents, doesn't necessarily mean that the value of the property is going to decrease, just the cap rate is going to decrease.
Dave, did we answer it, or do you want me to like explain a little bit about what cap rate is?
No, I understand that. I appreciate that. Thank you.
Okay, awesome. All right, I'm not sure who raised their hand first, Marie or Alec, but whoever goes off on mute first can go. How about Alec or Marie? Sorry.
I'm using my wife's Zoom, so it's Mark.
Okay.
Do you guys know, you said the prior tenant had it purchased it for 10 years. Do you know what they paid for it in 2012?
They paid, I think it was like
Hey,
700 or 800. Yeah, it was definitely a lot less. Real estate market prices were much different back 10 years ago. I think it was in the 7s,
Okay.
7 or 8. Yeah.
Okay. And then, did you guys give us the loan 12 years or 12 months out for years 2, 3, and 4? Was that in your spreadsheet there? What's the amount of the loan?
The total loan is 1.5 million.
And how much is it per year, the interest?
The
payment?
interest, well, the interest rate is 5.8%. And it's a 5-year fixed. The first year, we don't make any principal payments, just interest. It's interest
Right.
only. And then it's principal and interest thereafter, amortized over 25 years.
25 years. Okay, that's what.
Yeah.
All right, thank you. Okay. Good. All right, thanks. And then, last question. Is there water heaters in every one of these units, or how does the water? Because I was a little.
Yeah, each unit has their own electric water heater that's going to
Okay.
be attached to their panel.
All right, thanks. Good. All right, thanks. That's it.
Hey, Alec.
Hey, I guess it's a first question. So is it a 5-year mortgage or 25? 'Cause I heard both.
Yeah, no, great question. And so the rate is fixed for 5 years. And so it's a 5-year fixed rate, but the note, the 1.5 million is amortized over 25 years. And so basically that means it's 25 years times 12 is the amount of payments necessary to pay back the debt. However, you have to basically either refinance or sell the end of the 5-year term, because it's only a 5-year fixed rate. And so it's 2 separate things.
Yeah, got it. Okay. More of a just like housekeeping question, but have you guys done the inspection yet, or when is that report going to be or expected to be made available?
Yeah, Alec, thanks for asking. I should have actually touched on this in the presentation. So we've conducted a walkthrough that was alongside multiple contractors of different specialties. We've had roofers, electricians, plumbers, general contractors that focus on moisture barriers and protecting the foundation of the building. In addition, we've ordered and conducted a property condition assessment, which is conducted by an engineer. We have that report in hand. It's been reviewed. Generally, everything is pointing in the direction of this being just a very healthy asset. Now, in addition to that, the borough or the city or the municipality requires a certificate of occupancy or certificate of compliance or some type of equivalent. This this inspection has also been conducted, which actually wasn't required by the owner, but he's been a great seller to work with thus far. Pretty much immediately after signing the purchase contract, ordered this inspection. The inspection has happened and has produced great results. A couple final things that he needs to button up that he's going to take care of, and he's going to be handing this property to us with a current certificate of occupancy, which is huge because those types of inspections can uncover some unexpected costs. So we're going to be avoiding that risk as well.
Yep. Okay.
And sorry, one more thing. There will also be a environmental site assessment conducted, which will look at things like, mold and asbestos and other type of like environmental hazards. This inspection will be conducted prior to closing. So we'll have
that's like a regular phase one.
Yes.
Yeah.
Got it. Another question. So can you just talk a little bit about the timeline for the renovations, how that plays into the rent growth we've talked about, and just particularly, right, like I think there was a pretty low vacancy rate today. So how are all the renovations going to work logistically based upon whenever the lease end dates are and whether these tenants are renewing or not? Just have you guys gone and modeled all that out?
Yeah. So one great thing about the purchase here is actually every single lease is at its longest expiring in January, pretty much immediately when we close on the property. So if a lease is expiring, it's rolling over into month to month. So at any point, we can notify a tenant of 30 days notice of vacancy. We're going to be purchasing this property with 3 units already vacant, and we're going to be executing the business plan in phases so that we can still generate revenue, not cleaning house and trying to get all the renovation done as quickly as possible. We're going to be doing it in phases. In addition, a strategy that we're going to try to implement is speaking with existing tenants and seeing if they'd be open to working with us through the renovation and paying that new rent. So we're not actually missing out on the rent income on that individual unit through that period of renovating the actual unit.
Got it. And it sounded like when you guys were kind of modeling out the pro forma rent, I mean, was that looking at, I forget what page it is, looking at the comps per square foot relative to some of the other properties, or how did you guys land on the kind of uptick in the model that you did?
Yeah, no, that's a great question. And so first, we have a lot of experience leasing in this market. Just that's qualitative, and then, which has helped a lot. And so we just in general had a sense of like directionally where things would go, just because we've literally leased hundreds of times and over the course in this specific submarket. And then we kind of used our leasing process to forecast out what would we prospectively lease a unit renovated in this specific market. And so we pretty much ghost shopped the core competitive renovated units in the area. We inventoried pretty much every single unit that was on the market for, apartments.com, Facebook Marketplace, Zillow, you name it, all the major ones in Emmaus and in South Allentown. And then we kind of aggregated it and like put them into buckets of where we felt that these were directionally more appropriate. And then we looked at what are the renovated ones, what are they going for? And then we wanted to kind of take specific qualities about those units, like were they bigger, or like are the floors, because there are certain nuances that tenants really care about. We've all been tenants at some point and still are. And so there's specific things that they care about, especially families, then like school safety and other things are more prioritized. And so we kind of pegged certain values to different sort of renovation improvements, and then kind of coalesce them together, and then looking at like specific comps that are really close, and then kind of discounting the aggregate of the averages of the renovated comps that are in the immediate area. and really taking like 10 or 15% off that. And that for both the ones and the twos. However, we feel that we're bringing more to the unit than the renovated competitors by way of the free parking and the extra storage. Like those storage spaces are like 10-foot high, could literally fit an extra bed, and it's just like free square footage. And these are like, I would call amenities for these areas that like, you know, it's not like you're getting a rooftop pool in Emmaus. It's amenity has a different sort of connotation in not a bad way, but that's just like, it's just a different sort of amenity.
Yeah, I hear you. Cool. Well, I gotta hop, but good work, guys, and looking forward to learning more.
Awesome. Bruce, I saw you were looking like you wanted to ask a question.
Two questions. One, what was the original ask of this property?
It was 2.1. 2.1
Okay.
million.
And was it a competitive process?
Yes, it was very competitive. And it is very different. I mean, maybe not for you, but for when you are separate from like residential, when getting into, you know, commercial bidding, and Rob can probably attest, track record and ability to close is very, very important. And so when a clean shaven 28-year-old goes up to a broker and says, I'm putting down 2 million, they, you know, it was very hard. It was very hard to get them to and so just to understate how difficult it was to actually get awarded the deal, we came in at 1.8, and it was way more competitive than we thought, of course. And the broker really likes us, and like really wanted to work with us, and really coached us to be able to try to win the deal, even though there were offers bigger. And we had actually beat out another offer of somebody that he's done millions of dollars worth of transactions with, and had just closed on an $8 million deal a few months ago down the block. And that deal was higher, and the broker essentially coached the offer to be more in our direction. And it was a huge testament to his faith in us and our ability to close, which may have been a little bit, you know, premature, but I promised him the world. And so we were really fortunate to be awarded the deal, long story short.
Great. Second question, the property that people are throwing baseballs at your building from, that's currently on the market?
Yeah.
And what is the
Crazy.
comparable valuation there?
$200,000 a unit. It's 15 units. Sorry.
So what is the comp?
more.
Like how does it compare?
I don't want to get ahead of ourselves because it's not under contract. It's just listed, and the market's turning, but it's listed for 3.3 million, and that's 15 units. And this is 13 units for 2 million. So, you know, again.
And anecdotally, your view of the quality of the property?
I haven't been inside of that property. But the condition from the units cosmetically is like a little bit, tiny bit less. Like some of the units are comparable, but again, we're renovating them. And so, and
Post renovation, how do they compare to
way better.
This property today?
Way better. They have like the old white appliances, you know, the really, you know, white fridge, like the, you know, laminate countertops or thing.
Got it. So you're favorably priced compared to that.
Yeah. It was really a gift. I was like, oh my God.
Great.
Yeah.
I'm good.
Cool. Any other? Hey, Rob. You're on mute. You can put it in the chat.
All right, again, in regards to reducing operating expenses, I know LED lighting on the hallways. I know commercial real estate, right? Some things just are ongoing, right? Is that is that something you guys thinking of doing in the near future, changing the light bulbs in the hallways to LED to preserve energy, one from an economic perspective, from an eco perspective, also helping us reduce operating expenses, right? Is that in scope?
Definitely, yeah. I mean, I think there's going to be a lot of low hanging fruit, like you mentioned, Martin, replacing light fixtures and bulbs with LEDs, these types of things. Having the asset management and property management arm, as was discussed during the presentation, we have full control over these things and can implement these types of things quickly. We're going to be looking at the numbers on a consistent basis, on a weekly basis, and finding new opportunities to increase rent, putting our heads together, Jason and I, and also the other members of the team that exist on the property management side, and with Josh, our head of finance. These types of things, we'll continue to think about new and creative ways to increase rents and decrease expenses, definitely.
And the reason I mentioned, I know it's a stupid question, but I currently live in a 34 apartment building, and we just put LED lights about 3 years ago. We haven't changed the bulb since. My dad is a super in my building, and he would change light bulbs every other 4 or 5 days. And the risk was involved that he would get on a ladder and do this, right? He got injured, right? And he's going to sue the building. So I'm just thinking up from that perspective. So thanks, Jake, for that. Number two is, in regards to, you mentioned repairs being done while the tenants live there. Is there a legal document that we're going to have the tenant sign in case, they say there are working in the apartment unit, the tenant's there, tenant slips and hits yourself with a hammer that shouldn't be there, quote unquote, while the guys are working there? Are we going to have the tenant sign a document saying we are approving to work in their property while they live there?
Yeah, this is actually something that we've implemented on the property management side, and with our existing properties, we've had tenants that have agreed to, stay in the unit and pay increased rents post renovation. It's just something that would be built into a lease. So it would be stated what work is done and what the rent would be on the back end and what the timeline would be.
Got it. And the reason why I do mention that, living in New York, had a shareholder here, guy did some work in an apartment unit, actually reglazed her tub. It was just a regular handshake agreement that she was going to stay there, and she ended up going to hospital, and then all of a sudden I wants to kind of put the bill on the building, That's why I'm mentioning it.
No, definitely. There's always that type of risk, right? This is something we still have to run by tenants. We project maybe, a handful of these tenants would agree to something like this. But really the more the merrier, because that's going to, although it does come with associated risk, it does allow, as we mentioned before, to not lose out on the rents during that renovation. And the renovation is going to be pretty short as well. Really shouldn't take more than a month per unit to do this type of work. And we can work on multiple units at a time. Reason being, we're not doing any type of extensive plumbing or electrical work. It's really all cosmetic.
Yeah, the tenant who's been there for 41 years, obviously she likes the building pretty well. Is she's one of those tenants that are at risk to getting her rent increased, or she'll stay the same?
We're not monsters. we're good guys. You know us pretty well, Martin, hopefully.
I do.
But I mean, her rent, it's significantly below market. I think there's always going to come a time where
she's a Mary from 1241.
What's that?
She's a Mary from 1241.
Pretty much. Well, okay. No, it's a good point. We could have definitely increased the rent more on Mary. We'll see once we talk to her and she gives us the sob story. No, but actually, we would love to have the tenants stick around if they can. At the end of the day, we do need to meet returns. So if that means the tenant moving out, I think that's something that we would be open to helping her out with, is finding alternative living. And the fact that we have the property management company in the area, we can assist with this potentially. So it's a really good point. I think this would be a concierge type service for probably her and her alone, but definitely something to think about.
Rob, do you have a question?
I do. Can you hear me now?
Yeah.
Okay, great. I believe someone who's previously on this had asked this already, but the response got a little lost for me. What is the exit cap rate that you're assuming in your financial projections?
6.25%.
6.25%. Okay. As it relates to your value add plan and your CapEx budget of 166,000, what's the breakdown of that? Is it primarily for the interior upgrades, or are there some other items built into that?
Yeah, so this is first of all, let me just caveat here. This is a rough breakdown. Numbers are still being finalized as we're collecting estimates from material suppliers and from contractors. Large majority of the renovation budget is going into the apartments themselves. Some of it is going into electrical work. Like I had mentioned, we're going to be separating out apartments 12 and 13. There's a little bit of plumbing work not necessary, nothing really major. Most of this, as mentioned, is going to go into a large majority is going to go into the apartments themselves.
Okay, great. And you said that this budget is pending and changing, but do these costs include labor as is, or is that an additional cost?
Yeah, so numbers would include materials and labor.
Okay, great. And if you could, please remind me on what the average premium you're projecting.
Yeah, so I would say that the premium on the ones is around $125 for the ones. And then the premiums on the twos is closer to 200.
Okay, great. Regarding other, I guess, potential levers to pull from a value add or value creation standpoint, Martin touched upon, I guess there are laundry machines in the basement that are coin operated. I'm going to take a contrarian view and I'm going to ask the question, do the floor plans have room for hookups to be installed and for the asset to be vented? Because if you could do that, let's just say at a cost of about $3,500 between, the hookup installation and then the appliances themselves, and you get an extra $50. It's about 17% or so return on cost. So it would be somewhat accretive to what you are projecting from a overall turn standpoint. I think the yield on cost would be pretty attractive in return on investment there. But I guess my question to that is, do you, as the owner, do you own the machine in the basement, or is that on a contract? And if it's on a contract, what's the remaining term?
We own the machines.
On the machines. Okay.
Really, it's an interesting strategy, Rob, and obviously you've definitely been a great assistance to us, and thinking about these types of things in different ways. So, would love to chat more about it and how you analyze the the idea of running plumbing in each of the units for their own laundry. I would say that in some of the apartments that could be feasible, there is opportunity potentially to put the laundry in the storage areas. As Jason had mentioned, these storage areas are huge and definitely would allow for plenty of space for actual storage and also for laundry. It's just not something that's been worked into the budget.
Okay.
I think it's something we'd be open to analyzing more potentially.
Okay, great. And I guess to that point, what are you seeing? You did a great job touching upon kind of what some of these other competitive properties were charging from rents, but do you see other properties, including washer dryers, or charging for them or charging any sort of premium there? And same thing goes with parking. Right now, is parking free to residents? Is there an opportunity to kind of upcharge residents for that? And do you see that in the market elsewhere?
Yeah, so I think it varies. Like there's a 90 unit community that's like a mile and a half from 347 Broad. Parking's obviously included. It's less dense over there. And it comes with a washer dryer, but they're classic units, like laminate countertops and rugs everywhere. And they just are so close to having a really nice space, and they just and it really sorely needs a facelift. And that's a comp that's renting for $1,640 for the one beds. And that's the unit type. It was built in 1992, but still, it's nothing to write home about at all. And the thing is because of it's so close to downtown that there's not like a ton of parking. And so there's like street parking around it, like in neighboring buildings, but like dedicated parking, I would say I would consider it an amenity. And like, I would want to be careful about trying to chart, like, I would say in a normal environment, like totally. But if we can get a tenant to stay by not charging them the rent, because we really want to hit our pro formas in like a pretty uncertain time, like maybe that's a way to keep them and like not really anger them. I don't know. It's a good question. And so
Yeah, I was just curious if it was,
if
you
we
know,
can get away with
you
it.
kind of looked into. Yeah.
Yeah, we can
Okay.
get away with it.
I mean, I think this goes without saying, but given that you guys also have a affiliated property management company, do you see there being opportunities just with some other income related items, whether that's on the leasing side or damage bill backs, things like that? Do you see an opportunity for some operational improvement there?
You're saying in regards to the existing leases in place?
No, I guess on the income side, from future leasing, as far as things like application fees or billing back former residents for any damages. I mean, do you see any opportunity to improve operationally?
Yeah, great question. Actually, how exactly the existing owner has gone about additional fees hasn't been like analyzed in any type of detail. We would, I think, kind of assuming Kurt was more of the existing owner, more of a hands-on type of guy, build a relationship with the tenants type of guy. So he didn't think about it as analytically. Either way, it doesn't really matter because every lease is going to be our lease. Every tenant will be on our lease, whether they're an existing tenant or a new tenant. And we've implemented these types of strategies with our property management company. We charge application fees. We charge leasing administration fees. And we also have built into our lease specific costs for damages that upon some type of, or upon move out would be deducted from their security deposit. It's a separate addendum that is signed by the tenant and breaks down everything very specifically.
Awesome. Great. I guess last question for me, assuming this were stabilized today based off your experience operating in the market, I mean, what sort of cap rates are people paying today, or really call it 3-4 months ago before rates started rising? I mean, what was the cap rate for stabilized product in this market?
So I would say stabilized product would be like low fives, and like value add would be in the 4s.
Okay.
Like the going in cap was like around 4.4, 4.5. And as you know, value add cap rates are a little lower because the in-place rents are lower. And like stabilized go for in the low 5s.
Okay. Great.
Cool. Thanks, Rob, for your questions and guidance along the way. That's for sure. Any other questions before we call this we call it a night?